All right, we have Rohit sir with us. Sir, can you quickly just give us a mic check so that we can make sure everything is clear on your end?
Yeah. Good evening, everyone. I hope you can hear me.
Yep, loud and clear. Thank you so much, sir. All right, so we have a full house now. We're ready to start the conversation. Hello and welcome, guys, to this ET Markets and StockTwits India Twitter Spaces. Joining me with as in this conversation as my co-host is Kshitij Anand. He's the editor of markets at etmarkets.com. And like we all know, the person, the man of the moment, our guest is Rohit Srivastava. He's the founder, strategist, and author of popular market blog indiacharts.com. For those who don't know, Rohit Sir brings to the table over 30 years of experience in the stock market. He's previously held some of the top levels at brokerage firm Sher Khan, where he was the head of research and eventually the fund manager for their portfolio management services. Obviously, he's a very well-known voice in the market space and is a regular on some of the top business news platforms. And we really appreciate him taking the time out and agreeing to do this. Awesome. Rohit, sir, I'll kick things off. 2022, it's been sort of an insane year, so to say, extremely volatile and uncertain for equity investors. Yet, our markets are very close to their all-time highs. How would you describe the past 12 months? Can you paint us a word picture?
Yeah, thanks a lot, Yash, for conducting this and having me on. It's been a really volatile 2022, and it's been a phase in which we've had to rethink our own strategy and approach to the market. And before I really, give an insight into what I'm, thinking as of now, it may be fair to reflect on how we really got here in the first place. So that's an important insight, and then it really helps you understand why we think of things the way we are thinking of them as of this moment. So it all takes us back to 2019 when we had the tax breaks announced. The markets rallied for a while into Jan of 2020, and then from there, of course, the pandemic hit and the market sold off, getting one of the sharpest corrections that we have seen in a while. Now, it's very important to reflect back then that between 2018 and 2020, we did not see a new high in the broad market. So that means that even though the Nifty was appearing to keep on coming back to 12,500 once, twice, and then thrice, the mid and small cap indices were actually making lower lows, and a lot of stocks were losing ground. And so, actually, a lot of money got lost, and the Nifty itself was really not giving us a clear picture of what was happening below the surface. This is a very important lesson of that period that people need to take, because markets change their behavior over time. Nothing ever remains the same. And that's really important to understand, because uh, that behavior then helps us to understand, acknowledge what happens in the future, because it's always history that we take as a gauge to look at what might be the trend in the future. And also, if history changes along the way, we have to also get a sense of what exactly changed in market behavior that we need to keep an eye on. So sometimes cycles change, sometimes seasonality changes. And so 2018 to 2020 was that one period where we saw an elongated distributive phase where the Nifty kept giving us a picture that all is good with a lot of positive news flow, but in the underlying stocks were selling off and cooling off to the downside. The pandemic, of course, created a panic reaction, which gave us a long-term opportunity to start buying and investing. I mean, it's the good old market saying that buy when there's blood on the street, but the question is how many people are eventually able to execute it. Now, of course, there's good news that a lot of participation did start in the Indian market after May and June of 2020. If we go by the news flow at that point of time, that a lot of new demat accounts were being opened, the NSDL accounts were being opened, and that led to a sense that there's broad participation coming in. So that's the good side of it. So I really want to hope that a lot of people have participated on this upside. But surely different people come in at different points of time in a market, and that really changes their perspective, resulting in debates about what you should do in the market at this moment. So
Mm.
now I've summed up the story. What really happened, so for me, is that the sell-off into, I think, April, and then the starting of the recovery, April, May, is looked like an opportunity. Initially, it looked like a trade, but as we got into May, I think it became clear that we were looking at what I've called is the reflation trade, which is essentially that the falling dollar was going to drive up commodity prices. That's the bet that we took, and the dollar continued to fall for the next 1.5 year, and that particular trade paid off pretty well, and it resulted in a pretty broad-based market rally. So what could have been only a sector-specific rally, I think, became a pretty broad-based rally, and we also ended up getting value buying in sectors which also we were able to anticipate, but it's lasted longer than I thought, which is value buying into places like PSU stocks. Okay, and then spreading specifically, we've seen recently only PSU banks, but I think it's the entire PSU basket that most people, you can say it was the most hated sector that came to light. Now, there are a lot of parallels to whatever happened here with also what happened in the late 1990s, which we can come to later on. But having said this, if you've
Mm.
participated in this uprun that we've seen over the last 1 to 2 years, uh, the question in my mind then arises, do we continue to ride it, which is one side, or second, do we really protect the gains and go into capital protection mode? Uh,
Right.
I waited till April of 2023 to take a change in stance. That is, whether we should just keep riding this bull with the horns. And I think the resultant breakout that we started to see in the dollar, which means it was completely reversing course from what I thought would be a lasting bear market in the dollar from up to 2024, that completely changed. It sort of changed our stance on what is really happening, and unfortunately none of that has really changed. So even though the market's gone down to 15,200 and it's come back to 19,000, the big picture scenario on the macro front, which has changed, has really not gone back to where it was, which means the risks are still on the table, which is why, uh, having switched side from the bull case to the potential bear case, I'm calling most of the moves, up and down moves of the last 9 months, as a part of a bear market rally. Different sectors participating differently, and we are keeping open the risk to the downside. So that is the approach right now, and with that, we are heading into 2023, keeping our eyes that there are risks, and you cannot really go blindfolded into the new year.
Awesome. That was a very comprehensive answer for the 2023 outlook. But, sir, I also wanted to know your thoughts on flows. Will this market be largely dictated by foreign flows, and how do you see, or what sort of an impact do you see, at least in the short term, from China reopening?
So the China reopening story has two sides to it. The one side is that surely as it opens, it's going to perk up demand to some extent. The other side of the story is that, given China did not get fully vaccinated, and they're going to face some health related issues because of the reopening, they could be the rebound into what we call full capacity could actually take some time. It is coming. It's not that it's not coming, and so there is a positivity below it. At the same time, it's not going to happen overnight. It's not like come January and demand goes into full swing from China. It will slowly develop below the surface, but uh, to what extent will it be sufficient to negate the negative impact of what is a tightening liquidity condition across various other economies? And does the strong demand from China really help in changing the direction that central banks are taking? And that is where I think the questions become really tough, because if demand remains strong and if people start perceiving that no commodity prices will remain high, and the elevated levels of inflation don't really change, then it means it allows further room for central banks to keep liquidity tight, which they already think they're going to do, and the market is ignoring as of now. but the tight conditions eventually are going to hurt, and I think that's the real risk that we are watching out for.
All right. So, considering everything that you've said, and the performance in the markets over the last 2 years, although 2022 has been sort of a flattish year, relatively Indian markets have done better than most of their emerging market and developed peers. Do you think 2023 we can continue this outperformance, or will there be some sort of a mean reversion?
I'm in the camp that there is going to be a mean reversion, specifically in the case of valuations as interest rates start to go higher. One of the reasons I highlighted the period from 2018 to 2020 was for the similar parallel that below the surface the market is not doing well. On the surface, we look at the index and we think life is good. So for most people who are holding on to portfolio and have some kind of diversified portfolio, which means they're owning more than 30 stocks, their performance would not be matching the market simply because more stocks are down than those which are up. There's just very narrow list of sectors that have actually outperformed. Apart from that, everything else has actually cooled off. You can take the leading sector of last year, like technology, for example, which is lagging far behind what the market is doing. So those kind of things are hurting. Even and the same as with people who have mid cap and small cap exposures, those are hurting. So we are not really seeing the same kind of activity even at a higher market level than that we did last year. So having said that, I'm not in the decoupling camp. I don't think India can stay away from what is happening in the rest of the world for very, very long. We've managed to do that just like other parts. Like, for example, most people would think that Europe is in serious trouble, but if you actually look at European markets, are they really down huge from the all-time high? The answer is no. Same is the case with Japan. And then you must ask the question as to why that is. And the reason really is that many of these economies have followed divergent economic or monetary policies over the last 12 months, which means while the US was actually tightening policy, Japan was saying that we are not going to do it. We are still going to keep buying bonds at 0.25%. Europe was still doing QE for most of the last year. Only in June, I think they started to raise rates, and only now they are talking about going from QE to QT. So this divergent policy, what it really did is while it led to a tightening condition in the US, it's actually aided or supported the other markets, which means European and Japanese markets have actually fallen much less because the central banks have been supportive through monetary policy, and that's the same situation that we should understand was true for also for India. We've had easy policy even in the most recent central bank policy meeting announcement. The RBI governor is talking about removing the excess liquidity, 1,25,000 crores worth of excess, which he's noting, and this liquidity has been allowed to stay around for longer. And it's been their approach because they've said time and again that they want to support the economy. So they've sort of been supportive, and that's why our markets are holding up. But we are going into a point where we are seeing tightening, right? So we are seeing tightening of liquidity in not just US. Now Europe is stepping up its game. Japan has given the first indications of stepping up its game, and India is also starting to do that more, a little more. So I think this entire tightening cycle, which may last for another 6 months, is going to hurt growth, specifically at the bottom line. So if we even say that okay, the top lines are you're going to have a soft landing, even then the bottom lines are going to hurt because we had peak earnings growth due to the reflation, and that earnings growth takes a hit in terms of the rate of growth, and so that is where the valuation corrections will start happening. I mean, it's already happened in the US. I think it's not happened in India, and I think the time is coming.
But there seems to be some issue with the audio.
Okay, am I clear now?
Yeah. Please go ahead.
Okay. So I'm not sure where you missed me from.
You were mentioning about the policy tightening.
Yeah, so the policy tightening is now moving from the US to other parts of the world. So US was the only one tightening. Now you have Europe tightening, Japan taking steps in that direction, and India also moving in that direction. So now it's no more a situation where US was standalone, the only one tightening policy. Now it's all central banks tightening policy, and that is not a good mix as we head into 2023. And my sense is that as bond yields continue to rise, you may or may not have noticed the last 3 days you have seen both European and US bond yields going up.
Yeah.
Then the direct impact of that is on valuations. Okay, so moment you get interest rates going up in India, we're still not seeing an uptick. I'm monitoring very, very closely two things. One is what is the currency doing, which is USD INR, and second is what is the Indian 10-year GSEC really doing. And if it does move above 7.4, 7.5%, then we are really breaking out of a long, not only a long consolidation zone, but also a 6-year, 7-year downtrending channel, which will sort of, break out from its downward trajectory that was there for a long time. And the risk then is that interest rates rise much more in India than most people are anticipating. And when that happens, I think it's going to create what I'm calling again and again a valuation correction for India as well.
All right. So on that note, given the outlook for equities isn't that great, should investors move towards safe haven assets like gold and silver? We've seen a multi-year breakout, at least on silver as well. Again, it is touted as an inflation hedge. Do you see commodities, especially precious gold and silver, being in the forefront on 2023?
So, in rupee terms, the answer would be yes. In dollar terms, may or may not be yet. And the reason for this is that, when you have a tightening condition, it causes the dollar to get stronger. Or even if you have, real interest rates going up, it's usually good for gold. But having said that, when it comes to currencies, when currencies start to weaken, then in the weakening currency, the price of gold actually tends to go up. And this is what we are actually seeing if you measure gold in terms of euros or you measure gold in terms of even rupee terms. You take the last 6 months when gold was making a new low in dollar terms in the month of November, it was not making a new low. In fact, it's making a higher low in rupee terms. And the reason for this is that that gold is not just inflation which is in fact it's increasingly not an inflation. It's actually a if you're in a currency that is falling apart, owning gold really saves you from in the, so right now we've seen the rupee, for example, move from 72 to almost 82. That's a 10 rupee move, and that entire move has caused gold to remain elevated in rupee terms, which is what I think is going to be the case. So for Indian investors in gold, it's probably a good time. So it's a good asset allocation to have rather than equity. And for those who can actually consider an allocation, even dollar is a hedge because it's one and the same thing, right? You're either buying the dollar versus the rupee, or you're buying gold versus the rupee, one of the two.
Got it. Sir, you mentioned about how in the past Nifty has performed, but the underlying sectors of the broader market haven't participated. You spoke a little bit about IT stocks as well. Just wanted your thoughts. For anyone in 2022 who went with the losers or the underperformers of 2021, which were banks and autos, they made a good buck. Can the same strategy apply in 2023 where, say, you buy IT stocks here? Or do you think that there'll be more pain ahead?
So here is how I describe the last year again in parallel with 2018 to 2020. I see this as a more broad-based distribution phase, something that most people are not used to because historically, Indian markets tend to have this peak euphoria type of peaking process. Everything goes up and then it falls down, and we are not seeing that, and that is why it makes us feel that maybe this time is different. However, what we are seeing is distribution at a sector level. So each sector has peaked at a different point of time in the last 1 year. Say, for example, mid and small caps in January, along with IT. You have seen the metals index peak out in April. You have seen probably power and capital goods peak out in September. You're still seeing the PSU banks, rally recently into sometime in December as well. And so this rotation with different sectors performing, and autos of course did well when the market was actually falling between April and June. So this cyclical rotation is basically a large distributive phase according to me. And once we are done, which I think we almost are, or probably have completed at the recent high, max I'll give it till maybe early January. then I think the next leg down of the market, whenever it develops, is going to be far, far more broad based. It's going to include most sectors going down. So people actually looking for a place to hide that, okay, IT is down a lot, maybe I buy that and then I should, and I can sell something else which is up. Will that strategy really work? And my answer is it might not. The reason IT is down and underperforming is because it has global exposure, and the greater risk in the markets right now is in the external sector, not in the domestic sector. So the arguments towards the strength of the domestic sector are true, but the problem really is coming from outside. So in the beginning I mentioned that you can make a parallel of this with what happened in the late 1990s. Okay, so what we've really seen in terms of cycles is the entire period from 1994 to 1997-98 was a long consolidation phase for the Indian economy, which meant that sectors which are cyclical, whether it's metals, capital goods, power, cement, all of these stopped making new highs. They went into a long consolidation phase with wide swings on both sides, and that's also something that we saw between 2010 and 2020. Okay, so in fact 2011 and 2020, so we've seen many of these sectors not perform. Now what happened during Y2K, which was mostly a tech bubble, you got many of these sectors gain momentum because of value buying. Okay, so if you go back and look at Reliance between 1998 and 2001, in 2001 the tech stocks had fallen 80-90%, and the Sensex had broken its 1998 low. But that's not what happened with Reliance. That's not what happened with ACC. That's not what happened with many of these sectors that had broken out on value buying. They had not yet entered their growth phase, but you had the first round of value buying or the first signs of a turnaround after a 7-8 year consolidation. I think what you've seen in 2020 post the pandemic is essentially a similar pattern where sectors that were lying dead and nobody was really interested in have all given strong rallies, broken out. Some of them made new highs, 52-week highs or all-time highs as well. This is the first wave of buying into these sectors. I think the sell-off that we might see in the next year might simply be a pullback, kind of retracement to those gains that we have really seen. The extent of that is still questionable. What can it be? We can have different answers based on our understanding, but the risk really is that everything that has done well uh, is the first sign of things changing, but change has not yet happened across the board, and which is why the next decline should probably lead to a higher bottom in many of these sectors, maybe, and that would be again a buying opportunity, but probably the last. So of course I'm not saying it's all gloomy. It's like we've had the first wave of these sectors starting to do well, which is really good from a long term point of view. But what should not be overlooked is that you can get a deep retracement because you had the power index, for example, making new highs week after week, month after month, for almost 2 years. That's a pretty long one-sided run to have, and then not to expect that you can actually get a pullback and you need to, probably protect some of those gains is what I'm really trying to highlight. It's time to protect those gains by doing some level of asset allocation changes, raising cash levels, whatever actions suit you best based on your risk profile, because each one is different. I have done what I think is apt for me, but each one may be different. Somebody might want to raise 30% cash, somebody might want to raise more, somebody might want to allocate to gold, whatever it is. But when you've made significant gains over a 2-3 year period, not protecting those from the potential loss that might come from what is a very very changed environment globally, which is again I'm highlighting tightening liquidity conditions across economies, uh, is something that you really need to be wary of right now.
All right. You did mention about how the risks are in the global market and not in the domestic market. And, there's sort of a general consensus that financials may continue to outperform in 2023. While the broader outlook for markets isn't that great, is financials one space where investors can take cover in 2023, or would you rather look at other opportunities?
So that really comes down to whether you'll get credit growth or not. And if you're going to have interest rates spiking, which is the risk I'm highlighting, then it's possible that credit growth actually slows down rather than speeds up at higher interest rates, and that is the risk actually. So in that sense, what would happen to earnings growth for financials, which have been doing well by lending more and more and more? to know that, for a fact, in places like housing, loans have been extended for longer and longer tenures. Earlier it used to be 15-year loans, then they became 20-year. Now people are even offering 30-year. So when you have these kind of changes happening, you're basically extending people as far as they can on credit. But when interest rates go up beyond a point, like housing loans are already running at 8.5%, you push it to 9, you probably won't get any demand. So you're at a very tricky point when it comes to rates. To keep expecting people to perpetually consume simply on credit as a business model, especially when rates are rising, is going to be tough.
Got it. One last question from me before I toss over to Kshitij. Like you said, it's been an insane year. Any learnings that you'd like to carry forward with you into 2023?
Yeah, so I think this market behavior, which I talked about, was new. It's something that we saw for the first time in 18 to 20. I didn't think it would happen again. So when you get a peak like we did in October of last year, you would have said typically it should just follow down along with the US and so on. But we've actually seen a lot of rotational activity between sectors. This is sort of something that we have to get used to. Maybe it becomes a pattern for years or decades to come in future cycles. So that is something to be aware of, and therefore it means that we have to do our portfolio management as we do. At a sector level or a stock level much more, and we can't really do it just at a market level. Market looks peaking out. Do we really get out of everything? Probably the learning is that you have to look at each and every segment and take actions step by step in stages.
Got it. Kshitij, over to you.
Thanks, Yash, for that, and good evening, Rohit. Thank you for taking time out. This is the last week for the year 2022. But sorry for picking into your Twitter account, and let me ask you: is it time to stop with our dollar obsession in 2023? What are your views on that?
Yeah. So what has really happened? So with the dollar, I'll tell you what is going to happen is there are going to be divergent moves between different currencies, which means that in a tightening environment, there are going to be many currencies that will weaken against the dollar. However, when it comes to the dollar index itself, the kind of move that we really saw, last year might not, continue at the same pace. And the reason for that, and again, I've spoken to other macro thinkers, and they don't agree with me. They say that in a weakening environment, the dollar index typically it still tends to get stronger than others. But the reason is what I mentioned some time back: the policy divergence which was there, which is the US was the only one tightening, and because the dollar index is basically a cross rate across pair of currencies, so it's like the yen, the euro, and so on. If all of them start hiking rates and the rate differentials between different pairs don't expand as much as they did last year, then it's possible the volatility that we got used to in the dollar index, where it's moving half a point, 1 point, all every other day, that may really come down significantly. And so simply watching the DXY to predict what might happen next in markets uh, might not work as a strategy. At least you might not see the same kind of volatility in the dollar index that we've become used to. The place to then really look would be one at your individual currency, which is why I'm talking about USD INR. Okay, so if it continues to move higher, we are clearly seeing weakness in our own currency relative to the dollar, which has to do, of course, with the tightening environment. The second is look at bond yields. I think people have probably started to think, well, if the Fed's going to pivot, bond yields are going to cool off. But that event is probably 6 months away. In the interim, yields are still rising, which is why I highlighted even last 1 week the markets are paying attention to yields that jumped specifically in Europe, because the Eurozone has mentioned that they're going to continue to tighten and even go back on QT.
Right.
And you've seen European bond yields breaking out and rallying hard, and then US yields followed. So watching yields is, I think, going to be the thing in India. I'm going to watch the 10-year. If it crosses 7.3, 7.5, above 7.5, I think it runs away to catch up with 9%, which is a wild thought. Most people may not agree right now, but it's a major breakout when you look at a bond chart.
Right. Although, you've spoken about currency or rupee earlier in the chart as well. So, how are you seeing the, rupee chart for the year 23?
So for now, I've had levels of 85 to 87 for the current move that is ongoing, which is in progress.
Hmm.
That is the current outlook. But I'm not ruling out that it does eventually cross 90 at some point of time. I'm not sure if it will do that in this move itself or it will consolidate and then go there later on.
Okay.
85 to 87 at least right now is the expectation in the coming months.
Right. So, a rupee weakness could actually translate into some bit of weakness in equity markets as well.
It should. It should. There is a strong correlation.
Historically, the scenario has played out.
Yeah, that's how it has mostly been, and it pushes foreign investors also backwards, right, in terms of uh, you know increasing their flows when your currency is weakening.
Right. Now, you've also spoken, your view on the FI activity. So, if let's say we look at the FI activity for the year 2022, how are they placed for the January series? You could say that. So, let's not take it for the whole year, but at least in the near term, ahead of the budget.
So, see, I actually don't try to study the cash market activity because it's not been a very good forecasting tool. It just tells us in general whether they are buying or not. In fact, FIs have generally been buyers apart from a time like last year. If you go back 20 years, they are mostly buyers in the Indian market. Uh,
Hmm.
and so their cash market activity is not a good forecasting tool, especially from very short term moves. So we actually end up looking at the futures positioning. The futures positioning, which is released by NSE, which we also know as the participant wise open interest data, that does meaningfully move from the long side to the short side between FIIs, clients, and now even DIs have become a large force because
True.
last year they almost had 80,000 contracts short in the month of October, and this year also last month they had gone up to 73,000 contracts short at some point of time in November. So, which is before we peaked in December. Now, some of those shorts have come off, so we don't have an extreme positioning which was there at the start of December or at the end of November, where FIs were long almost 125,000 contracts. That's not there. Now they are mildly short 10, 20,000 contracts, which is not a lot. So looking at futures positioning, I can't really say there's a big swing this way or that way. But what we are seeing as the market is declining is that FIs are increasing their shorts and the other side clients are buying the dip because that's the psychology right now. That psychology continues, then we may reach a point where markets get oversold, but we are not there yet. And so my way of thinking about it is that we've not fallen enough for an extreme positioning to be reached where you can think of a short covering kind of rally, which was true at the start of October, which was true in the mid
Mhm.
of June, but is not true right now.
Right. So, in fact, the shortcoming rally, especially in the month of October, led to a fresh record high. So, probably not at this point in time. But in the meantime, the next big event which the market will be tracking, is Budget 23. So, what does the history sort of suggest how markets behave during this period, and if any particular strategy, probably which sort of traders can deploy in the current series?
So Indian budgets have been very interesting. The number of tops and bottoms that have occurred on budget day is fascinating. Even though it's happened so many times and we all study it, it happens again and again and again. So it must have a lot of sentiment gets built around budgets. The expectation that something big will be announced is always there.
It's true.
Uh, Increasingly, even though in the last 5 or 10 years, finance ministers have repeatedly said that budget is not a policy making space, and they usually don't announce big policies in the budget. Even then, markets look forward to hearing something coming out of there. Uh, what would they do now when they are 1 year ahead of what is going to be an election year? Because it then be the last full budget. There are people who are expecting they'll go out of their way to spend, and therefore the markets will do well. My counter argument is that if you have really studied the history of the uh, Indian balance sheet, Indian governments have actually been very prudent. Okay, when we really needed help in the late 1990s, I think
Mhm.
under the previous government at that point of time, we raised the debt to GDP, which is the public debt, government debt, to around 90%. So by 2002, it was almost at 92 or 93% uh, at that point of time. And since then, it was brought down to 62% by 2018, 19, or 20. That's a huge reduction. We've heard this talk about fiscal deficit year after year after year. We have to control it like it's some bad thing. The fact is, they've actually controlled it. When you look at this data, what I've just spoken of, the only time right now, I think some people may see the numbers jumped right back to 80-90% is because of the pandemic. Right, so the numbers gone back up because of what we've done through the pandemic, and we've had to take that burden on. Otherwise, we've been very prudent. Now, if you think that, well, this is the last budget, they have a chance to win the next election, they'll go out of way and, run up this debt to GDP from 90% to over 100%. I would be surprised, because after 2 decades of different governments being very prudent about the Indian balance sheet, to think that they would, mess it up is beyond my imagination. So I think it will be a very balanced, normal budget. I'm not really going to have huge expectations here right now. I think if they have some firing power, they'll probably save it for a rainy day, which makes sense because of all the, I'm sure they're also aware of what is happening around the world, and they should probably save the firepower for when they're going to need it.
Absolutely. So I think the right expectation would be, I think the government will do the right thing, because that's what we've been doing, and it's not been very populist budget that the government has actually brought in the last you could say 4 odd years, or the current terrain. In the meantime, what are your expectations from the budget, Rohit?
So, like I said, if it's going to be balanced, there's actually, I would actually say, end of the day, it might be much of a non-event. Few changes here and there. There are lot of talk around tax changes, but I don't think there'll be anything big on this long-term capital gains or any of these things. I'm actually not expecting anything much coming out of this budget, really, apart from them continuing with the current state of things. I think the only thing I hope for, which I've hoped for the last 2 years, especially since the pandemic, when they actually said that we want to sell off PSUs that are non-strategic, and they started that process. I'm not sure why that process didn't take off at full pace. I mean, it should have. And if there's anything, this is an opportunity to finally get that boat rolling. That PSU stocks have done well. It's a great time to get rid of non-strategic investments and raise cash, which would really help us in the year ahead. Did you get me there, or did my voice cut off?
Yeah, I think there is some issue with Kshitij's mic. I'll just quickly take over while he sorts out
Yes,
the
yes,
mic.
yes. I'm back. Yeah, I'm back. I'm back. Right. Sorry about that. Now, Rohit, one more thing. I'm sure you're tracking all the charts, and any 2 to 3 stocks which are particularly looking strong on the charts for the year 23.
Now you've given me a googly. Because I am here speaking about broad-based market decline risk, and of course I should highlight that, see, we don't provide advice, so even
Okay,
talk
okay.
just with you
Not in
and
if not in terms of
not
levels, broadly.
yeah. So I actually thought for a while that maybe it would be defense, maybe it would be pharma that would work, and they
Right.
did defense for a while. It's still doing. If there's any sector left, I think it's defense, which you can see growth and there's some amount of buying interest. Pharma somehow is just not working. Okay.
Mhm.
So I thought it would be the last sector I would be holding on to, even though the market falls. I'll not go 100% cash. I'll hold on to some pharma stocks, but they're not working. So I've actually given up on the pharma theme. So I can't actually think beyond defense right now. What would be the theme that will work? If there are geopolitical risks, somehow the metal and energy could actually be an outlier still, even though they've in a general tightening environment, you expect metals to not do well because rates go up and commodity prices come down.
Right.
But if geopolitical risks builds up, then if not metals, energy, which is oil related stocks, can can actually be a surprise at some point of time. So those are the things to watch out for. So defense and energy are places to watch out for, but everywhere else, I would think you're going to see more pain on the downside.
Right. In the meantime, finally, what will matter the most in 23 in terms of what will guide market direction?
So it's going to be the currency and bond market. Two things for Indian investors. I'm just watching USD INR and the 10-year tech yield. These are just two places that are all the time on my screen. The way they go is going to tell us whether risk is getting elevated or we've really come out of the woods. So those are the two things that will really guide me.
Right. Over to you, Yash.
All right. We do have a few minutes, Rohit sir. If you don't mind, we'll just open the floor to any of our listeners if they have any questions. Do keep in mind, Rohit sir won't be able to address any stock-specific questions. So, in case if you want to know his opinions on any specific sectors, then feel free to send us in your request, and we'll quickly add you back as a speaker. All right, and while we wait for the requests to pull in, Rohit sir, one last question from my side. Just thinking, at the top of my mind, you said something along the lines of government disinvestment, etc. Could this rally in PSU stocks continue even in 2023? Most of these names have run up quite a lot. Perhaps buying on dip would be an ideal strategy, or would you just straight away steer clear of any of them?
So it completely is up to the government policy, right? So if they actually announce the divestment, then I think the interest in these stocks will remain, because that's, I think, the main that can be the main trigger for them to stay at these levels. Otherwise, they would probably go down with the rest of the market. So I think that's the main policy move to watch out for.
All right. Gaurav, you've been elevated as a speaker. Go ahead and ask your question. You can unmute yourself and ask your question. Gaurav, can you hear me? I guess there is some issue with his connection, I guess. In the meantime, we have another request from Manu Ayyar. So go ahead and unmute yourself and you can ask the question.
Hi, can you hear me?
Yes.
Awesome, thank you. Rohit sir, just wanted to understand the implications of currency, what you spoke about, USD INR, and how that would impact, what would be the impact of the broader markets here, assuming it goes down towards 90.
See, the first impact is that for that time being, when the currency is weakening, your flows really take a hit, because investors who are bringing in money usually tend to stop doing so, waiting for a better price of entry. We have seen a historical inverse relationship between the currency and the Nifty. So every time the currency weakens, the Nifty weakens as well. USD INR goes up, Nifty goes down. So you usually like to wait for that in terms of getting a better opportunity in terms of entry point to the market itself. So that's what it brings to you. Longer term, though, a weakening currency, like I mentioned earlier, even for the eurozone, like if they weaken the euro, it actually helps the market from falling less. So if I actually go back to 2013, when the rupee fell from 50 something all the way to 69, the Nifty did go down, but a lot less than we would have thought. So the currency actually provides support, because it's sort of a way of let's say it's a stimulus of types. because you're expanding your money, which means your rupee, when you're weakening your rupee, you're basically expanding monetary policy in a way that you have more rupee relative to dollars floating around. And if that is true, then it stimulates. But it stimulates only after you're through with the panic stage, which means once you're sat through a currency devaluation, it gives you great buying opportunities because the eventual stimulant, that is a weaker currency, flows through the economy in terms of better exports, or even prices fall less. So, for example, if metal prices fall 20%, but the rupee weakens 10%, net your metal prices are down only 10% in local rupee terms, and so everyone benefits from a weaker currency. The only problem is at the time it is weakening, don't expect it. So sometimes the narrative goes, oh, currency is falling by IT stocks. So it doesn't work that way. After you had a currency devaluation by IT stocks. Okay, so that's the main difference. It's more a timing thing.
I hope that answers your question, Manu. Next question is from Pooja. You can go ahead and unmute yourself. Pooja, can you hear us? All right. I think there's some issue with her connection as well. In the meantime, Rohit sir, we have got one more question from the comments section. True Heart, pretty interesting name. He wants to know your view on the chemical sector.
Now, a lot of chemicals have also been recently export oriented. They've benefited from rising prices, they've benefited from order flows. I would look at, see, all of these sectors are going to do well, but all I'm looking for is a better entry point, better valuations to buy. I think the things that I'm really highlighting, which is higher rates, which can cause a valuation correction, is to me the opportunity basically. So I'm waiting for that opportunity that I can get things at better valuations, which are growing because of the given environment that we are in. Otherwise, I think we are seeing a turnaround in so many sectors longer term that it's really interesting. Those are going to be places we want to be invested in. It's just a question of the timing being right. Here's an example I've been giving recently. Say, for example, you own a stock at 100, you think it's going to go to 150. It means you're going to get a 50% return. While people discard timing or understanding of things like value, if you're able to get a sense of that, and if you can say, well, because of the environment or for some reason prices are going to fall, and if 100 becomes 50 and then eventually achieves your 150 target, then from 50 to 150 you're getting a 200% return. So the difference between a 50% and a 200% return was simply a 50% drawdown, and that I think is key in terms of why you wait for these situations where for some reason there's blood on the street, and then that's a much better opportunity to buy. So why jump the gun? Why be in a hurry? Why get into FOMO? Rather wait for the right opportunity, because such opportunities always come along, is what we have seen time and again.
Awesome. With that, I think we're completely out of time on this Spaces edition. Once again, Rohit sir, thank you so much for agreeing to do this space session. It was a really engaging one. Tons and tons of learnings. So for all those who perhaps joined late, they can go ahead and listen to this recording all over again. It'll be the first pin post on our Twitter handle. So go ahead and follow us and check it out over there. While you are there, do not forget to sign up to our Daily Rip India newsletter as well. This is your host, Yash Upadhyay, signing off.
Thanks a lot, Yash. Thanks, Kshitij.
Thank you. Thank you, Yash. Thank you, Rohit. And wishing everyone a very happy new year.
Yes, happy new year to everyone. Yes.
Happy New Year, guys.
Great. Thank you so much. Good evening.